Welcome to The Explainer. Today, we're digging into a number that's usually buried deep in some corporate spreadsheet, but has this incredible power to shape the world we live in. We're talking about the cost of debt. Let's get right into it.
It might sound a little dramatic, but it is absolutely true. The entire valuation of a company, the final price tag in a huge merger or acquisition, can swing by millions, even billions, just based on getting this one metric right. It is the hidden engine behind some of the biggest decisions in the entire world of business.
So here's our game plan for this explainer. We're going to start with what the cost of debt really is, then uncover this kind of hidden discount you get from the government. We'll look at how analysts actually find this number, tackle some of the trickier scenarios, understand its limits, and finally, see what it really tells us about a company's health.
All right, first up, let's figure out debt's real price tag. And I'll tell you right now, this goes way deeper than just the interest rate you see printed on a loan document.
So what exactly is the cost of debt, or KD as you'll often see it? Well, put simply, it's the interest rate a company would have to pay if it went out to borrow money today. We're not looking backward at old loans. We only care about the current, right now market price of new debt. It forces us to be forward-looking. And this is so important to get. A company might have a fantastic loan from 5 years ago with a 3% interest rate. But for valuing that business today, that number is totally irrelevant. What actually matters is the rate the market would charge that very same company for a new loan today, based on its current health and, of course, today's economy. Okay, now for a really fascinating twist in the story. It turns out that debt actually comes with a hidden advantage, a kind of discount that's courtesy of the government. To really get this, we have to look at the cost of debt in two different ways. First, you've got the pre-tax cost. That's the headline number, the rate the bank quotes you. It reflects the raw risk of lending to your company. But then you have the after-tax cost, and that's what the company actually feels on its bottom line. It's the true economic burden.
So how does this actually work? Well, it's all thanks to something called the interest tax shield. Here's the deal. A company pays the interest on its debt before the government figures out its tax bill. Since that interest payment makes its official profits look smaller, the final tax bill is lower. That tax saving is a very real benefit that makes debt cheaper than it looks at first glance.
And the impact is pretty significant. Let's just take a quick example. Say a company borrows money at 5.6% before taxes. If they're in a 25% tax bracket, the government is effectively giving them a discount on that interest. Their true after-tax cost of debt drops all the way down to just 4.2%. That is a massive difference, and it's one of the main reasons why financing with debt is so attractive. Okay, so we know we need the current market rate for debt, but how in the world do analysts actually go out and find it? Well, there are really two main paths they take. It all depends on whether the company's debt is public. If it is, think corporate bonds you can buy and sell, analysts can just look up something called the yield to maturity, or YTM. That's the market's live, up-to-the-minute opinion. But for private companies, analysts have to play detective and actually build the rate from scratch. This synthetic rate has two basic building blocks. We start with what's called the risk-free rate. That's usually just the yield on a government bond. Then we add on a credit spread, which is really just an extra bit of interest to pay the lender for the risk that this specific company might not pay them back. So how do analysts figure out that credit spread? Well, they look at the company's vital signs, its financial health. For instance, a high interest coverage ratio means the company is earning plenty of cash to cover its interest payments. So that means a lower risk premium. But a high debt to EBITDA ratio? That signals a really heavy debt burden, which means lenders are going to demand a higher premium. This is where you see that direct link between how a company runs its business and how much it costs to borrow money. But of course, finance is rarely that straightforward, right? The real world is filled with complex, hybrid types of debt that can really throw a wrench into our neat little calculations. A perfect example of this is the convertible bond. This is a type of debt that has a special feature. The owner can convert it into company stock. Now, because that option is valuable, these bonds usually have an artificially low interest rate. So the big question is, can we use that super low rate in our calculation? No way, absolutely not. Using that low rate would be a classic mistake because it would seriously understate the true cost of borrowing. The correct way to do it is to completely ignore that low interest payment. Instead, you have to find the yield on a regular, non-convertible bond from the exact same company. That's called the straight debt yield, and it shows us the pure cost of their debt without any of the equity bells and whistles. Now, this is really important. We have to understand that our simple after-tax formula has a huge limitation. It doesn't always work. There's a big gotcha you need to know about. The logic here is actually pretty simple. The tax shield is only valuable if a company has profits to shield from taxes in the first place. I mean, you can't get a tax deduction if you're not paying any taxes to begin with, right?
Take a look at this profitable company. As you can see, its earnings are much bigger than its interest expense. This leaves it with positive taxable income, which means that tax shield works perfectly. It lowers its final tax bill.
But now, look at what happens with an unprofitable company. Its earnings are already in the red, so adding more interest expense just pushes it deeper into a loss. It has zero taxable income to shield. The tax benefit just vanishes. For this company, the true cost of its debt is the full, higher pre-tax rate. This is a critical distinction, especially when you're valuing startups or companies that are struggling.
So, let's bring all of this together. The cost of debt is so much more than just an input for a formula. It's really a powerful barometer of a company's overall health and the market's perception of its future. It's this dynamic number that tells a really fascinating story. It weaves together the big picture, all that macroeconomic risk captured in the risk-free rate, with the specific unique story of one company, which is captured in its credit spread. A low cost of debt is basically the market giving a thumbs up. It's saying it has confidence in the company's operations, in its strategy, and its ability to deliver down the road.
And I'll leave you with this thought. A company can go out and tell any story it wants through marketing and press releases, but at the end of the day, its cost of debt, that's the cold, hard number that reflects the market's real verdict on that story. It's the price of credibility.